Madhuranga, Chief Finance Officer at PayMedia Private Limited. So he will explain risk and returns, how to apply their company and how they are experience risk and returns. So Mr. Madhuranga, so let's have some discussion about it.
Okay, Mr. Madhuranga, thank you for giving us your time for this. So let's start from the very beginning. So my first question is, according to you, what is risk and return and how does it apply for your company?
Thank you very much for coming today. And what is return? Basically, return is what we expect from something, right? So let's say if it's a business, it may be a profit. If it's an investment, it may be a revenue or income. It may be interest or it may be dividend or something in return. In my case, I will give you some example according to the PayMedia company. In terms of return, we do actually business and we do some investments. If we do business, we expect profit, and if we do investment, we expect something related to the investment. It may be interest, it may be another investment on a startup or another business, then again dividend out of those business. So risk is basically if you expect something, if you are not getting the same thing, we call it as risk. What you deviate from the expectation, what is the actual income or actual revenue you are getting from the expected revenue, so that is called risk. So in my term, in my company, when you look at the risk, I can see many risks. We are working with many stakeholders. There might be credit risk. We are working with, we are having some operational maybe operational issues, then we have liquidity and operational risk. So we are working in different countries in the world, so we are facing with exchange risk, then again different political risk, liquidity risk, and again we are dealing with a new market, then we are facing market risk. So likewise, if there's any government changes, then we are facing with political risk. So there are so many risks involved in this business. That is all about the risk and return in terms of my experience.
Okay, thank you, Mr. Madhuranga. I think we have received the answer for my question. So let's move to the other question.
So Mr. Madhuranga, now we want to know how do you compare historical returns to future returns when making your investment decisions for the company?
So basically, historical return is based on the past performance, but you already get. You already have that data. It's with you. Historical returns. Expected return is something what you estimate. Right? It's future one. You can't expect the exact data, exact return from future projections, but you can predict. That is based on you can predict based on the market conditions, then future growth of the market, likewise by different, let's say, different microeconomic factors. Based on that, you can predict some data. Based on that, you can predict expected return. Let's see how we can use these two data to make decision. Let's say I'm going to make an investment. Usually in my company we do some investment on startup business, tech startups especially. When we look at the tech startup investment, what we are doing is we check their historical data, how they have already performed during the last couple of years or maybe 1 or 2 years, right? So based on that, we check their expected returns also, how they will perform in future. So we take both data and make decision. Therefore, I can say that both, even though historical data valuable, we don't take solely historical data for decision making, but we take expected data as well. These both data are really helpful when making investment decisions.
My question is, how do you view the concept of portfolio risk and return, and why are they important in your company's investment decisions?
portfolio risk and portfolio return. Portfolio is something you have, something you call, you have different investment bundled together, then we call portfolio. Question is why you are asking, why you are investing in different portfolio. We need to mitigate the risk. That's why we are investing in different assets. Portfolio return is that the total amount you are getting, it may be a loss from one asset, it may be a profit from other assets. So look at the total of the return you are getting from different assets, what you have invested on, we call portfolio investment, portfolio return. Again, the portfolio risk is the same as the normal risk. The risk that your entire portfolio face is called portfolio risk. It may be a gain, liquidity risk, market risk, political risk, any economical risk. It can be any kind of risk, but that will affect any risk that will affect your entire portfolio is called portfolio risk. When we are making the decision, why should I consider portfolio risk and return is, so let's say I'll give some example. So I have invested on some startup business, and I have invested on some fixed deposits, and again in the same time we have invested on some money market also. So that different investment give different returns. When you look at the business side, every time it gives, business usually give profit or loss, but fixed deposit always give interest. It's a fixed or risk-free income, but you are not getting the same profit from your business. It can be varied. But to manage the entire investment, we need to have a balanced portfolio. Otherwise, our entire investment will be a loss. When we make a decision, so we need to consider what kind of investment, what kind of asset in our portfolio, what are the risks associated with this portfolio, and what are the associated risks under each asset. That will help us to give a maximum return out of the portfolio investment. So that's why we need to consider total return and the total risk when we make a investment decision. In addition to that, when we are planning the future or the sustainability of our company, so we need to consider again the whole portfolio investment and risk also. And when we look at the strategic, when we look at the financial stability of the company, again we need to consider our total portfolio investment and portfolio risk also.
Okay, Mr. Madhuranga, my question is, so what is the role of correlation when it's come to when it's building a diversified investment portfolio?
What is correlation? Correlation is how two investment or more than different investment move together. One investment might give you high income, some might give you low income, and some might affect some kind of risk factors. Then the same risk factor will not affect to other investment. Then these are called correlations, how investments move together. When you make a portfolio, so you have to consider these correlation factors. I'm investing on the same industry, same type of company, two different companies, but in the same industry. So these two move together, they have a positive correlation. Let's say something happened to that industry, both my investment are affected. It might the same way. So that factor gave a loss. So my whole portfolio is lost. Then when you look at the correlation, you have to always decide whether this correlation is positive correlation or negative correlation. When you make a portfolio, you need to have both type of investment in your portfolio. That will again give you a high return and low risk. That's why you need to consider correlation when you make an investment decision. I'll give you some practical example. In PayMedia, we have different investment portfolio assets. We have invested on some startup business. Those are not in the same industry. We have invested on some agri-tech firms, then fintech companies, and normal software development companies which are not in the fintech and agri-tech industry. In the same time, we have some investments in fixed deposits. Again, those are in different banks. So let's say something happened, and one more thing, and we have invested on some new market also, and we do some innovation also. That is also a part of the investment. The reason we are not investing on the same industry, same asset or same bag is this correlation factor. If something happen to one of this industry, our entire portfolio make loss if you have invested in the same industry. If something according to our experience, let's say if something happened to fintech industry, my overall portfolio is still making profit because of other industry perform really well. One more thing, we have not invested in Sri Lanka. We have invested in other countries also. You can remember we had some political risk last few years. So if something happened to our business in Sri Lanka, still we generate profit or generate revenue from foreign businesses. That is also called something related to correlations and portfolio management.
So, Mr. Madhuranga, my question is, what is efficient frontier and how does it help to investor choose best portfolio in the company?
So, what is efficient frontier? Efficient is something the optimal, we call optimal. This will give you optimal combination of, let's say you have different investment in different areas and you have a limited resource, limited fund. You have to manage this fund to get the maximum benefit. Then how do we invest? We have limited fund, but we have different options. That is why we need this efficient frontier, because it gives the best possible combination in different investment. Let's say you have A, B, C investment opportunities. The maximum what you can spend is like 100,000. You can decide whether how much you are going to put for A or B or C, whether you are going to only put for A, B only or B, C only. Likewise, the combinations. In our case also, we are facing the same problem. We have different, very limited fund. So, but we have many opportunities to invest, but we are not going to invest on all the opportunities we are getting. We select few, and the selection is based on the return, maximum return you are getting from out of these investments. So we select only one or two, maybe three, right? Not all the entire opportunities. We select only few, and investment that is again based on the maximum you can get from these investment. So when you consider this combination, you always consider the associated risk also. So let's say we are getting a high return. At the same time, if that return give high risk, we are not investing on it. May not be a best option, even it gives the maximum return. We should balance the return and the risk also. In that case, the efficient frontier is really give you a best possible scenarios, best possible options for the limited resources what you have.
So, Mr. Madhuranga, from my side, I have two questions for you regarding the beta and the security market line. First is, how does your company use the beta to measure the risk of your business compared to the overall market?
Practically, we do not measure beta, but we consider some market risk factor when we make a decision. So in my case, actually, we are not in the share market, or our shares are not selling in the market, or we are not more into marketable investments. We usually do private investments and risk-free investment. So again, even if it is risk-free or very low risk investment or the private investment, we always consider market risk, associated market risk. Let's say if I am investing on a agri-tech startup business, we need to think about what are the associated market risks in that particular business. Let's say that agri-tech business is now really evolving, right? So, and this industry might affect the technology. The technology get evolving quickly. In the same time, the global economical factor also will affect to that industry. Even as I mentioned you, whatever the investment we made, even we are not measuring the beta factor, we always consider market risk factors which affect to beta when we are making our investment decisions.
Thank you for that. So the other question I have is, do you use the security market line to check if the return you give to the investors is fair based on your level of risks?
It has two aspects, as an investor and investee. So as an investor, we expect this security market line actually give you an idea what is the reasonable amount, reasonable return you can get from that particular investment. So as an investee, this security market line will give you an idea what is the reasonable return you have to give to the investor. This security market line is very important. So when we make a decision, an investment decision, we can, by looking at this security market line, we can consider whether this investment is giving us more than what the reasonable amount or less than the reasonable amount. You can, based on that, you can decide whether we have to go for that particular investment or we are withdrawing that particular investment. When you, even after you invest on that particular asset, you can always monitor whether this investment continuously give at least the security market line investment return or not. So based on that, you can make a decision, good decision, investment decision on your investment assets.
Thank you for it.
Difference when they are both risk and returns, new projects for investments.
Right. Thank you for the question. So if it is a new project, we always consider risk and return. So because I'll give you an example. In my company, we do innovation. Innovation is actually a new project. So before making that initiative, so we always consider risk factors and what is the expected return we are getting on that particular innovation. I'll give you an example. We develop software, right? So most of them are innovations, innovative product. So we don't know what's happening, what will be happening to that particular innovation, and therefore we do market research and we check whether there's any potential market to that particular innovation, or whether what is the customer base, what will be the customer base of that investment, and in the same time if there are any rules or regulation will affect to our innovation, because we provide software to finance and payment industry, basically fintech. We are in the fintech industry. So that fintech industry or finance industry always be affected by regulators, central bank regulator, banks regulations. Then let's say we invest on we put a new product to the market, but if it doesn't comply with the regulations, then we can't put that particular product to the market. So before any of new product launch or new product development, we always consider associated risk factors. In the same time, we check whether this the product can be developed in-house or whether we can get it from the outside based on the return we are getting. Let's say I have product called KYC. I can sell this KYC product per KYC at 1 USD. But my cost is more than that, and even though the market is there, if my cost is there, higher, and if the competitors are giving at the same product at a low price, right? So I can't continue I can't make the expected revenue, expected return. Again, we consider expected return when we are making a new product. So I'm telling you, this risk and return is very important when we are making a decision on new projects, on new investments, or on new innovation.
Okay, Mr. Madhuranga. So for the final question of the day, can you briefly describe how does your company balance risk and return in practice, like especially during volatile markets?
Right. How do I manage, or how do our company manage risk and return practically? So I'll give you some practical examples. So as I mentioned we are dealing with different business activities in different countries. So we have to work with different currencies. So we are exposing with this foreign exchange risk always. So in that case, when we go to a foreign market, we always come to an agreement with them. It's kind of a hedging, but it's not that what you exactly the hedging what you are studying here in your degree or something. But it's kind of a hedging that we have a pre-agreed rates, terms, and conditions to reduce this foreign exchange risk. So that is one example that we are mitigating our risk to get and to maintain expected return. In the same time, we are not working same market, right? So we work with banks, we work with insurance companies, we work with finance companies, right? So our product is different. So we are not investing in the same product. So as I mentioned you, this technology is evolving and it get expired quickly, right? In that case, if our business line is doing the business in the same line, so with this technology changes, we can't survive. So again, we have to think about the associated risk and returns, and we have diversified our entire product portfolio to different sectors. Even if we go to the foreign market, we have business in Maldives, we have business in Nigeria, not in the same region, in the same market. It's different region, different markets. So, and when it comes to cash reserves, so let's say I'm getting a lump sum payment sometimes. So in that case, if I have a cash reserve, we do some short-term investment which give you a high return compared to the normal market. Example, money market. So we maintain huge cash deposit, and we sometimes, that's for a very short-term period, that may be sometimes 24 hours or 48 hours. So what we have done is we have invested on, we have created, opened some money market account, and we have put those money in that account. So it will give you a high return very quickly and with very low risk sometimes. So even in we have invested in some fixed deposits, we have invested in lands. Those are basically based on the risk and returns. So to answer to conclude this conversation, what I can say is, whatever the investment decision you make, you have to always consider this risk and return, because these two are very important factors on your decisions. So let's always what you have to do is you have to select the optimal combination and diversify your investment that will give you a maximum benefit.
Thank you, Mr. Madhuranga. So that's the last question of the day. And thank you for your valuable time.